Thank you, and thanks, Hub, for the opportunity to speak today. Microcaps is an area we're very passionate in the market. I've been involved in the small companies product at Perennial for 10 years now. We've always had between 20 and 30 microcaps within our small cap strategy, but last year we made the decision to launch a dedicated microcap fund, and so that's what I'll be talking about today. And the key lesson I want to leave you with is what really attracts us to this market, and that's the under-researched nature of the universe. So why microcaps? As I alluded to, it's an under-researched part of the market. We think it's a very inefficient part of the market, and that leads to strong excess returns. If you look at some surveys from some of our competitors, most managers are doing over 10% excess returns per annum. We're only 1 year old in our fund, but we did over 27% excess returns last year, so off to a good start. And we think the reasons why those excess returns are going to persist in the future is the under-researched nature of the market. What we really like as well is a very diverse universe. Over 2,000 companies we can invest in, and unlike when you look at the top 100, we're not forced to own any banks, not forced to own any resource companies. I think if you take the top 4 or 5 stocks in the ASX 100, you've got 40-odd% of the market. It's complete opposite the microcap end. As I said, 2,000 stocks in that end of the universe. We also have the ability to invest pre-IPO. That's not something I'll talk about today. Just to give you some more numbers around the under-researched nature, this is data from Factset. So as I mentioned, 2,000 companies in the universe. That's looking outside the top 100 down to right down to nil market cap. On average, if you look at the coverage, there's only 500 of those 2,000 stocks actually covered by any brokers, and that's every broker in Australia that provides the data to Factset, which is most of them. You compare that with the top 100, there's 12 analysts per stock. So as a fund manager and as an investor, it's very hard to get an edge in the large cap end of the market when there's 12 other highly paid analysts covering that stock. Whereas you look at a micro cap, clearly some of them aren't covered at all, and on average it's only 0.4 analysts per stock. So we've actually seen this data trend to being more under-researched, and Goldman's put out an excellent piece just this month, which I've taken the liberty of taking some charts from. So they talk about the rising information asymmetry in small caps. So this applies to small caps, and I think even more so to micro caps. Exhibit 26 there, if you look at, this is the number of forecasts in the market over time for small cap stocks. And as you can see, we've gone from a peak of about 1,400 estimates out there down to 1,000 recently. And we're seeing the resourcing going into small cap research drop every year. There's been a lot of changes with MiFID and other regulatory changes that I think is going to make this probably get even worse. So the quality of broker coverage continues to fall. Exhibit 28 shows you how fresh this data is. So the bottom line there shows the number of analysts ahead of the company's results. So in the last 100 days, how many analyst numbers have been updated, and that's trended down over the last few years as well. So what this says is for an active manager that's got a big team and can go and do their detailed research, there's mispriced opportunities in the market. The better covered the market is, the less opportunities there is for mispricing. And we really look for mispricing opportunities to make money for our investors. And so I'll run you through some examples that we've found over time and more recently. As I mentioned, it's a very under-researched part of the market, but to research it properly, 2,000 stocks, you need a very big team. I agree with Mike, company meetings are very important, and that's a key part of our process. We did over 1,000 company meetings last year. To do that, we need a very big team, and we're obviously leveraging off our small cap fund as well, given there's a lot of fund in there to help pay for this large team that you see there. Another key attribute of our fund is there's no personal ASX holdings. So if anyone in our team wants to have exposure to the ASX, they have to buy into our funds, and that just avoids any conflict of interest and ensures that all our staff are focused 100% on adding stocks for our investors. Just to elaborate on the process, again, we start with 2,000 stocks. The most important step in the process is really which ones do we reject. We do this a number of ways, the company visit program. Mike mentioned a couple of frauds recently, and we've met with a few of those companies, and you just come away not feeling comfortable. They get rejected and get put in the sin bin, and we won't look at them again until there's a material change in those businesses. So we're kicking out about 1,600 stocks out of that universe on day one. We then go and build up models. We do 10 years of history if we can get it. and 3 years of forward forecast to really build a detailed understanding of what the drivers of these businesses are. We then rank those stocks from best value to least value and build a portfolio between 50 and 60 stocks on that. The other important point from this chart is we run this is not just a set and forget process. We rerun this process every 2 weeks to ensure we've always got the best value portfolio that we can put together in the market. Some examples from our history as a small cap investor. As I said, we've been doing small cap investing for over 10 years and have always had between 20 and 30 microcaps in. A good example would be Melbourne IT. Some investors might remember that from the .com days. It had the monopoly at the time for .com.au registry. Clearly that was a great cash cow business, but it got opened up to competition. The stock faded off everyone's radar. Brokers dropped coverage. So at the time we were buying it, which was $1.65 pre a recent capital return, no brokers were covering it. And we saw an excellent cash flow, albeit not much growth in that business, but prospects under new management and some potential changes to really accelerate growth in that business. And if you go and have a look at the initiatives that have been in place since then, they've really supercharged that business, very involved in the mobile and digital economy. Great management teams come in and return that business to growth. So really happy with what's played out there. But we are a value manager at the end of the day. So we actually don't have a current holding in Melbourne IT based on valuation. Still have a very positive view on management though. Index is another example. Quite a bit of detail in this slide, but what I'm trying to show here is just when there's mispricing opportunities, when brokers are either not covering the stock or covering it poorly. So if you look back in early 2016, the brokers were forecasting 1 cent per share of earnings for Index. We've got a resource specialist based in WA, Sam Berridge. He attended the Diggers and Dealers conference in Kalgoorlie and gave me the feedback that exploration spend was starting to recover. There've been 5 or 6 years of underspend. We put increased exploration spend into our model, and we came out with a forecast of 5 cents per share, which at the time was 5-fold versus what the market had. So we built a very large position in our small cap fund and our micro cap fund in Index. You fast forward to now, all the brokers, as you can see, have all gone positive. There's 3 brokers now covering it. The green bar suggests they've all got buys on it, and the consensus earnings have all come up to where our forecast is. And that's really how you make money in the micro cap and small cap end of the market. You identify a mispricing opportunity and you wait until the market re-rates as that news flow catches up. Kogan was another example which came through our company visit program. Here with Amazon launching last year, everyone was concerned that Kogan would be one of the main stocks impacted as Amazon launched. We looked at some examples from Canada and the UK, and that suggested the opposite was the case. Some of the existing online players actually flourished once Amazon came in because people became more comfortable with spending online. So we met with management, really impressed with the founder who Mike mentioned having skin in the game. He was the biggest shareholder and still is. And we're really impressed what he was trying to do with the business. Some new initiatives, for example, they're selling mobile and broadband products on Kogan and really crunching the data that they get from their website. So we built a very large position in Kogan and have enjoyed a strong re-rating as the earnings have been delivered from what is a great management team. Another thing we find in microcaps is there's some pretty obvious themes in the market, and if you talk to any large cap fund manager, they're probably going to tell you about having exposure to infrastructure. And we all know if you drive around Sydney or Melbourne, even Brisbane where I was last week, the infrastructure boom is here, it's happening, there's money getting spent. But what most brokers are missing is how do you make money for that in a microcap sense? So the 2 stocks we've identified there are Veris, which I noticed Mike met with last week, and also SRG, which recently raised money. So these are 2 West Australian businesses that actually have East Coast presence, and most of their money's made on the East Coast. So by their nature, they're actually poorly covered by the Western Australian brokers, and we think that's created a mispriced opportunity where these stocks with great exposure to infrastructure boom have been missed by the market. And you can see the multiples there look very attractive. And finally, to sum up, we're trying to look for, at any time, around 60 of these ideas we want to have in the portfolio at any one time. We want to spread our risk, because you don't always get your timing right, you don't always get your stock calls right, so we want to spread our risk across around 60 stocks. but at all times our portfolio must be better value than the market. So you can see there the EV to EBIT of our portfolio is a 27% discount looking out to FY19 on a price earnings basis of 40% discount. We've also got superior growth in the market, 45% per annum growth over the next 3 years versus the small cap market, which is growing at 15%. And as I said, the trust is only a bit over 1 year old, but a pretty good start, 44% per annum return since inception, and the 1 year number of close to 52%. That's net of all fees. For investors looking for a longer term return series, they can look at our small companies fund. And we also provide some back testing of the microcap stocks within that fund if anyone's interested. Both to sum up, just some names of where we're seeing ideas at the moment. Mining services was a trade probably 12 months to 18 months ago that the market had ignored. We've made a lot of money out of this trade. The mining services recovery's happened. The earnings have been delivered. Share prices have responded. We still see some value in some select names, but that's becoming a bit more of a popular theme now. We've always been attracted to IT software, good cash flow generally in those businesses, and again, high management ownership in those names that are mentioned there. Agriculture and aquaculture particularly, we think is an interesting part of the market, very capital intensive, but in high demand at the moment. You've seen the salmon price rise. If you look in the supermarket lately, there's a bit of a shortage in salmon at the moment, so we think Huon's well positioned there. And into Asia, ocean-grown abalone, which is actually disappointed since its float, but we think that's a good long-term asset over in WA, selling into the Asian market. And a bunch of other names mentioned there. And worth noting that we've got Sam Berridge, as I mentioned, based in Perth. He manages the energy and resources names for us, and Avanco was one of the stocks he picked last month, and it was taken over by Oz Minerals, so he's adding a lot of value for us there. So that's it, and happy to take questions.